Amazon's forward price-to-earnings ratio just hit 24.5 times, the lowest since November 2008. The S&P 500 surged nearly 2% today on Iran's ceasefire hopes. Those two facts should not coexist, yet here we are. Let me put 24.5 in context. Amazon's 5-year average forward PE was roughly 63 times. Earnings have grown far faster than the share price, which is why the multiple has compressed so dramatically. In a normal market, this would trigger a stampede of buyers. In 2026, it is triggering a question. Is this cheap, or is it a crisis multiple? The last time Amazon traded at this valuation was November 2008. The S&P 500 was down 37% that year. Lehman had collapsed 2 months earlier. Credit markets were frozen. The comparison is uncomfortable, but it is not purely cosmetic. In 2008, Amazon's low multiple reflected genuine existential uncertainty about consumer spending collapsing. Investors didn't know if discretionary retail would survive. Today, the concern is different, but structurally similar. Will AI, specifically Google, Anthropic, and emerging models, erode AWS's pricing power? Will Amazon's capital expenditure cycle consume cash flow before the returns arrive? The Wells Fargo CEO flagged it directly this week. Markets and Main Street are disconnected. Wall Street is pricing crisis. Main Street is still spending. That disconnection is what makes this a history rhymes moment, not a history repeats moment. Amazon's revenue growth is structurally faster now than it was in 2008. Margins are expanding. AWS still controls roughly a third of global cloud infrastructure. In 2008, Amazon was a retailer who happened to be building a cloud. In 2026, it is a cloud company that happens to run the world's largest retailer. But here is the similarity that matters. Both periods share a single cause of multiple compression. Investors cannot see where earnings land 2 years out. In 2008, it was recession uncertainty. In 2026, it is AI disruption uncertainty plus oil-driven inflation uncertainty. Powell's warning this week, another supply shock is coming, means the Fed may not be in a position to cut rates to support growth even if the economy slows. Oil crossed 107 barrel this week. Gas hit $4 a gallon for the first time since 2022. Each dollar at the pump is a dollar not going to Prime memberships or third-party sellers. That is not a trivial headwind for Amazon's retail margins.
Oracle, meanwhile, cut thousands of jobs today while ramping data center spending, a sign that the AI infrastructure build-out is simultaneously destroying and creating value inside the same sector. Amazon faces the same pressure. Its capex is enormous. The returns are real but deferred. So where does this go? The 2008 analog eventually resolved into one of the greatest long-term buying opportunities in market history. The S&P 500 bottomed in March 2009, and Amazon stock returned more than 20 times over the following decade. That outcome required 2 conditions: a policy response large enough to restore credit markets, and a business model that could survive the downturn. Both conditions were met. Today's equivalent conditions would be a credible end to the Iran conflict that brings oil back below $90 Brent, and a stabilization of AI competitive dynamics that stops eroding AWS pricing confidence. If both materialize, Amazon at 24.5 times forward earnings is a historically rare entry point. The stock's forward PE has never sustained below 25 times for more than a few months, even in the worst post-2008 drawdowns. The weight of evidence points towards this being a valuation floor rather than a valuation trap, but only if oil comes down. Right now, the Iran ceasefire signals that drove today's rally are unverified. Trump's own ally warned today that ending the war without reopening the Strait of Hormuz is, quote, highly problematic. If the strait remains restricted through Q2, oil stays elevated, the Fed stays on hold, and Amazon's retail margins stay compressed. The 2008 analog would deepen. Watch Brent crude tomorrow. If it closes back below $105 on confirmed ceasefire progress, the cheap stock in a temporary shock thesis holds. If it stays above $108, the supply shock Powell warned about is not temporary, and Amazon's 24.5 times multiple has further to fall before it finds support. The rally today felt like relief. What it actually was may take another week to answer.